Hey guys, I'm 𝗥𝗙𝗙𝗖𝗪𝗏 from eToro. Welcome back to the channel. Warner Bros. Discovery is a company that owned the right to Friends, the DC Universe, Jaws, The Matrix, Harry Potter, Game of Thrones, and so much more. And since the merger with Discovery has been hit with blow after blow. First of all, the thing that they were saddled with immediately after the merger was $50 billion of debt, of which 15% was variable rate. Then they had the actors' strike, which meant they had to shut down production for an entire quarter. Then they lost the rights to the NBA. Now, despite the share price being low relative to when the merger actually happened, the stock has been climbing quite a bit recently. So I wanted to do a video on what I feel Warner Bros. Discovery is getting right. First off, one thing that Warner Bros. Discovery definitely got right after the merger was massively paying down debt. As I mentioned, we started with $50 billion worth of debt and about 15% of it was variable rate at a time where interest rates were at record lows. Had they not have paid down this debt at that time, then we would have been seeing huge increases in our interest payments in the later quarters due to the fact that interest rates took a sharp upturn due to inflation. The next cool thing after we paid down our variable rate debt is because of the high interest rates and high government bond rates, we were able to buy back billions of dollars worth of debt really cheap because the banks that had our debt wanted to sell it to us so that they could take the money and invest it in government bonds. Obviously, a bank would much rather own government debt than commercial debt. The next thing that I think Warner Bros. Discovery got right is that they have prioritized deals where they own content rather than when they rent it. The NBA was a huge part of the noise surrounding the stock as the share price was going down, and I think a lot of people thought that the reason the share price was going down was because of them potentially losing the deal with the NBA. However, I personally do not feel that the NBA had any impact on the stock. But I wanted to get some evidence behind this because certainly it seemed all over the internet that all everyone cared about in relation to Warner Bros. Discovery was the NBA deal. And so I wrote to the investor relations team and I wanted to find out how much that Warner Bros. Discovery believed the NBA deal made Warner Bros. Discovery. And I actually got a response from Andrew Slabin, the Executive Vice President of Global Investor Strategy at Warner Bros. Discovery, who said that the NBA cost about $1.5 billion to run and own and made around break-even profitability-wise for Warner Bros. Discovery. And in fact, we managed to turn getting the losing bid into an advantage because we are meant to be offered the chance to match any other bid, but because we did match it, but not quite. When we got rejected, that opened the possibility for a lawsuit, in which case we were able to get some access to the NBA at a much better price. And this is the thing, guys, having things that you rent is fine, but you got to get a really good deal when you're renting. We shouldn't think of sports as something that necessarily makes us money. It's a great way of bringing subscribers to a platform. So I'm not concerned when something breaks even, but you want a good deal, and really, you should be making money with every asset you have, especially assets that cost $1.5 billion. And in fact, I think this leads me into the third major point that I want to make on this video. The thing that I think Warner Bros. Discovery have got right is content. Most investors today are totally blindsided by technology. And it is crazy to think that in 2001, where technology was at that time, when I went to see Harry Potter and the Philosopher's Stone in cinemas. And if this had come out just a few years earlier, I most likely would have watched it on video later. However, because of advances in technology, I watched it on DVD. Then I watched it on TV again at Christmas with all the adverts in between, even though I owned the DVD just because it was on the telly. Watching TV at Christmas was a huge part of my childhood, and you'd open the TV guide and we'd all mark the things that we wanted to watch at different times. We actually enjoyed the advert breaks because there were little chances to go grab a cup of tea and some food and then come back and continue watching the film. But then by the time the last film came out, the next time I would watch Harry Potter would be on Amazon Prime, where I'd buy it again so that I could own the stream of the content. And then just recently, I watched it on Netflix because now Netflix seem to have, they're paying about $100 million a year to rent it off Warner Bros. Discovery. So here's the thing, no matter how much technology advances, I have watched and probably paid for Harry Potter about 10 different times the same piece of content, no matter what the technology is. All these huge companies that have done all this investment in new technology and new servers, Netflix, who pay billions to Amazon to use Amazon Web Services to store and distribute all of their films, while Warner Bros. Discovery, we don't have to innovate anything. All we have to do is keep making, and this is the key here, keep making original content. So I think I've established well enough that I think content has a much higher longevity than having the best technology. And I think all that Netflix has over Warner Bros. Discovery is they were early to the new streaming technology, and that is it. And so when we're getting around to pricing Netflix versus Warner Bros. Discovery, I want to make clear, because that's what should matter to shareholders, I want to make clear that I think Netflix is better than Warner Bros. Discovery, especially right now for the time being, and I think they deserve a higher market cap. So let's first establish how much does Netflix make per year in free cash flow. So free cash flow, Netflix makes around $7 billion a year in free cash flow, which is incredible until you learn that the market cap of the company, what you have to pay for that $7 billion, is $390 billion. Okay, that's a lot. Let me work out how much that is. That is 390 divided by 7. That is 55 times the free cash flow. Okay. And whereas Warner Bros. Discovery, in recent years, we've only got a few years after the merger, but they have been earning around $5 billion in free cash flow. Now, that number did drop by 5% or so, and the revenue had a little dip while they're paying back the debt, but basically just about $2 billion less than Netflix. So I might expect to pay half what Netflix is worth. So because this is earning a bit less, and because growth isn't as guaranteed for Warner Bros. Discovery as it is for Netflix, I might expect to pay half or potentially even a quarter of what Netflix is worth for Warner Bros. Discovery. Bear in mind that I do believe that Warner Bros. Discovery have the better content. There is 200,000 hours of content here versus 4,000 here. So let's write that on the board. 4,000 hours, which is a 4-digit number, versus 200,000 hours of content, a 6-digit number. And I believe that that content is of a higher quality than this content. However, because Netflix were first on the technology, I'll grant that, and they are growing faster, I do grant that they should have a higher valuation. But Warner Bros. Discovery is priced at $25 billion. $25 billion versus $390 billion. I'm just going to double check that now. Sorry, okay, they've gone up slightly in recent months. So they are now valued up at $29 billion. 6 times their free cash flow. Now, I don't care about the entirety of the stock market as a whole, but just looking at these two companies, it is not hard. You don't need to be very smart. This is what I mean when I'm talking about investing. You don't need to be that smart to realize that Warner Bros. Discovery is much better value than Netflix for the share price. Especially if Warner Bros. Discovery actually managed to succeed with HBO Max, they'll essentially have the identical platform as Netflix. What Netflix has done in relative terms, loads of companies are being able to copy because the technology is not that hard. It's just putting videos on the internet. But they aren't half the price of Netflix. They aren't a quarter of the price of Netflix. They are 13 times smaller than Netflix in market capitalization. I think one of the big reasons people are avoiding Warner Bros. Discovery that is not the NBA is the network linear division, which for me, is such a weird thing. I don't like the way the stock market is talking about it. There's an article that's come out about this concept that they are separating streaming and studios and the linear network division. But if you go into the financials of Warner Bros. Discovery, the network division is by far the most profitable aspect of Warner Bros. Discovery. I believe in the last quarter, in Q3, there wasn't too much interesting in Q3, slight decline in revenues. That's not that interesting to me. And the fact that networks continued to make $1 billion in net income in one quarter. So the thing that I really, really don't want to see, the thing that will make me sell the entirety of my position, is if there's an idea that we are going to split these two things off. I don't mind them sort of separating internally inside the company, but if they are going to be split and sold entirely, that would ruin it for me. What I don't want to own is, I don't think the stock market needs is another unprofitable streaming giant. What is much better is if they are self-funded using the network division. At the minute, I think it makes perfect sense to have these two units, the legacy unit and the new unit, combined. The only advantage I could see is having a clearer direction within both companies, but really it's just going to be, one's going to be left for dead and the other is going to be just another streaming giant that isn't making money. But Zaslav, the thing that you want to do if you want to be rich is